Okay, so for November 2018, question 2, November 2018, question 2, I will read so that I will just explain it very briefly under not up to 1 hour as well. I want to finish it so that you can. So X and Y division are two arms of the XY group of company. X division manufacture one type of component, which it sells to external customers and also to Y division. The following information relates to X division. All figures assumed correct. Y division assembles another type of products, which it sells to external customers. Each unit of that product requires two of the components that are manufactured by X division. The following information relates to Y division. So they gave us information of Y and so on. So they said group transfer pricing policy is 1. Transfer must be at opportunity cost. And 2, Y must buy from components from X. So requirement, calculate the profit for each division if the external demand per period for the components that are made by X division is 15,000, 19,000, and 35,000. That's where the problem is. Let me analyze what the question is saying. The transfer price is the amount division A or B or C, whatever name they call it, we transfer goods to the other division. Because they're actually trying to reduce creative accounting so that they will not be giving us fake profits. If they want to make profit, they can increase the price. If they want to make loss, they can reduce the price. But we don't want that to happen. And that's why there is policy for every transfer pricing between two divisions. So from this question now, division can be done, 1, at variable cost, 2, at cost plus, 3, at market price, and at opportunity cost. At variable cost simply means I will calculate all my variable costs. That is material, labor, overhead, whatever the variable cost is, I will calculate it, and that's the amount I'm going to transfer the goods to you. But at cost plus means still, I'm not here to be sleeping. I also want to, my division also want to make profit. If the total cost I spent is 20 naira, I'm going to add 5 naira to it. Then it means I'm going to transfer it to you at 25 naira. So the 5 naira is my profit. Then at market price is still, no worry. If I want to transfer anything to you, before I give you the answer, I'll first go to the market, go and price it. If it is 20,000, I'm going to sell you for 20,000. Why the opportunity cost means the external price minus variable. So if the external price is 20 and the variable cost is what? Is 15. It means I'm losing how much? I'm losing 5 naira. Because every company should transfer at variable cost. The normal thing is that companies should transfer at what? Except they state that otherwise. So now the price is 20 naira in the market, and I want to transfer to you using my variable cost at 15. It means if I transfer to you at variable cost, which is 15, I am losing what? I'm losing 5 naira. That 5 naira plus variable cost is what we call opportunity cost. So we are going to be using this question to illustrate. I don't want to use more than 1 hour for this one as well, so that the video will not be too long to share with you and watch it again for those who are not in class. So now we have the situation on ground is that this company wants to sell to internal. They want to sell to external. So they have their capacity. And that is the first thing you must be able to determine in every transfer price. What is the capacity of this organization? So this company we are talking about is division what? I think division X, I mean, is division X. So what is the capacity of this company of division X?
Capacity from 10,000 units.
Which means it's not division S we are talking about.
So, X is 35.
X is 35. So capacity of this is 35,000. Yes or no?
Yes.
So we also have 35,000. We also have 35,000. That is the first thing you must be able to determine. Now that you are able to determine, if you go back to the requirement, they gave us 3 scenarios. They want us to calculate when the internal, when the external required is 15,000, I think. 15,000. When they require, or even before we go there, let me do this one first. Let me talk about the internal. When the internal is what? They said we must give to internal. What is that internal? Which is Y? Division Y? Yes or no?
Yes.
How much must we give to Y?
10,000.
10,000.
Is it 12? Is it 10,000?
Demand from Y is 20,000.
20,000.
Y is 20.
20,000. The thing is that there's nothing we can do about it. We must obey the instruction given to you, except that division manager wants to give you one. The companies have already given you the policy that you must sell to who? To division Y. So you don't have option than to obey. You must sell to that division. Now, in this regard now, external are now requesting for what? For 15,000 under scenario 1, Abi? Under scenario 2, how many are they requesting? 19,000. Under scenario 3, what are they asking? 25.
35.
They are asking for 35. So scenario 1, scenario 2, and scenario 3. Now, we need to know if there is a problem or there's no problem. From this place now, 35 is the total capacity. They cannot go beyond the capacity. So they must give 20,000 to internal and then 15,000 to external. So there won't be any issue here. So they are good to go here. They can settle both internal and who? And the external. But in this case, 35, 20, 19, they must settle 20 internally. But if they are to settle 19 to external, they won't be able to meet them because the addition of these two is more than this, I mean. So they will be short of what?
4,000.
4,000 short. Now we have 35, 20, 35. The request from internal is 20. They cannot do anything about that. But they won't be able to reach the 35. So they will be short of what? 20,000. Of 20,000. And that's where the problem starts. For this first one, there is no problem because everything is okay. But for this second one and third one, there is a problem, and they won't be able to settle both internal and external. In this first one, where there's no problem, there will not be anything like opportunity cost. They will only transact to internal.
Sorry, Mr. James. It's going to be 15,000 short for, not 20,000. Difference between 20 minus 35, it will give us 15,000, not 20,000.
It's 20 now. This is 35.
It's 20 now. 35,
Then
20.
15 minus 35 will give you 20. Check what.
20 gallons. Okay, thank you. So it means because there's no issue here, there won't be anything like opportunity cost. The internal will sell or will buy at what? At variable cost. Then external will buy at market price. But here there's issue. That is where opportunity cost exists. So here it will be both variable costs and market price. But here it will be at opportunity and opportunity. Do we get that now? So opportunity cost, opportunity. Now that you have been able to analyze that, let me now walk you through the solution to that. So we have scenario 1, scenario 2, scenario 3. They ask us to do profit for the whole thing. So what I'm going to do, I will only do for what I can do for both X and Y. So that will not be. So for scenario 1, we need revenue. We need revenue. So this division X will be having 3 types of revenue. So the first one is that they have what we call external revenue. Or instead of external, let's start with internal. We have internal revenue. For the internal revenue, they must sell. You know, there's no problem with scenario 1. Yeah. So they will sell you all 20,000 units. At what price? How much is the what is the variable cost?
105.
So they are going to sell this at variable cost. This is 105. What do we get for that? 20,000 multiplied by 105. 2. We should write this one in thousand.
Yes, yeah, 210.
So that is for scenario 1. But there's still balance, they've done 20. There's a balance of external bit. Yeah. So we can put the external here. So it means they're going to sell remaining 15,000 to make it 35% and 35 units. How much is the market price to external? 200. That gives us what? 3 million. 3 million.
3,000. 3,000.
Okay. So that is for external. So they will hand this one from external. They will hand this one internally. Now, that is for scenario 1. For scenario 2, they must sell 20,000. Yes or no? So, division Y. But if they go this way, we can even calculate it ourselves. Let's see. We have 20,000 to sell at 105. And then they will now sell the remaining 15,000 at 200. It would have been these figures, Abby. However, they have more markets from external, which means they have opportunity. The external people are asking for 19, Abby. They have opportunity to say, I will sell 19,000. But they will reduce this one by what? By 16, because they cannot go beyond 35. If you multiply this, what do you get? 16 times 105, then 19 times 200. What do you get? 1680. Then this one, 3800. When you add these two together, this will give us 510. This is 510. This is 548. Do you understand? So instead of going this route, if they go this route, that is, they sell the whole 20 to internal and sell the remaining one to they will get this one. So they are missing 4,800. I mean, no, they are missing 380. Do you understand? But because they want to maximize every opportunity, they will now say, okay, see, don't worry. And they cannot sell this 16 to internal. If they sell 16 to internal, they are going against the policy of organization that they must give 20 to internal. So what are they now going to do?
So 16 will be sold at variable, while the remaining 4 will be sold at
So they will now say 16,000 at variable cost.
4,000.
Then they will say, CEO, because we want to obey our policy, the remaining 4 will still be sold to you, but we will not sell it to you at variable again. We will not sell to you at opportunity cost. So what is now the opportunity cost? Opportunity cost simply means the 200, the market price, minus the variable cost. That gives you what? 35, I mean? 95. Then plus the variable cost. What is the variable cost? 105. That gives you what? The opportunity cost is like saying I'm selling to you at market price. This is what we call opportunity cost.
Is it just coincidence that
Is it done?
is it just coincidence that they are both 200 or
It will always give you that 200. It will always give you that 200. As long as it's market price minus variable, then add variable again. So it's like we are just repeating the scenario. So it means this now 4,000 units will be sold at what?
200.
At 200 now. Do you get that now? So now that you have sold 20 from here, how much is the balance you have? You only have 15 because you cannot sell the 19. So you now sell 15 because you cannot go beyond your capacity times 200 the market price. Online, are you following me? I hope I'm not throwing it away anywhere now. So this will still give us the 300, Abi,
Yes.
and the 3,000. Then this times this, what do we get?
1,696.
1696. Then 4,000 times 200. Okay, it's wrong.
1680.
168. Then this times this,
800.
800. So this dash, dash, dash. So we are done with scenario 1 and 2 for the revenue. Then we'll go to scenario 3. Scenario 3 says that the internal must collect how much? 20. 20. Internal must collect 20 units. That's the normal policy. But external are requesting for how many? 25. It means we cannot settle both of them. And from here, external people are willing to buy all our units. So which means that if you set this one at 105, and you set this Because you cannot sell the whole thing. If you sell this remaining 15 at 200, you are missing because you could have sold this one, the whole 35,000 at what? At 200. So if you multiply these two together, the price will be lower than multiplying these together. Mute your mic, please. So that is why we said there is opportunity cost. There are some opportunities that they are missing if they go this way. So we say, okay, no problem. You know what we are going to do? We will sell the 20 to you at yes, at opportunity cost, because there's no price, there's no unit that is less for you to take. So we say 200, no, 20,000 units times 200 naira. Then the balance. This one is at opportunity. This one is also at opportunity. This one is at variable. This one is at variable. Why this one is market price? This one is market price. So opportunity this time, this what do we get now?
4,000.
4,000. Then we have the remaining balance. We also be sold at opportunity cost or market price. That will give us what?
3,000.
And that is all they ask you to do. That is all they ask you to do. So you can now bring this total revenue. This will give us 551.
5,480.
54. Do you add this one to it?
Yes, 5,480.
5480. 7 as it?
And 7,000.
And 7,000. And 7,000. 7,000. Online, can you hear me? Can we continue? Can you hear me?
Yes, sir.
All right, thank you.
Sorry, Mr. James. Please, how did you arrive at the 4,000 under scenario 3?
This one, that is 20,000 multiplied by 200. 20,000 times 200. This is 4,000. You get it now? Or you want me to explain it?
Please explain it, sir.
Okay. What happened is that the request from external was 35. Which means that we have opportunity to sell the whole 35 to external. But as a result of policy that we must sell 20 to internal, we will not be able to fulfill that requirement or that demand. But we don't want to lose any money. We will sell the 20 to internal, but not at variable cost. Rather at what? At opportunity cost. And opportunity cost simply means the market price minus what? Minus variable plus variable. And then we arrive at 200. Is that clear now?
Yes, it is. Thank you.
So we have done our revenue. I think we can do the cost under it. I'm not sure the cost is that much.
Sir. Hello, sir.
How about you?
Sir, please, I want you to recap that side you said earlier.
What I just said now.
Yes, sir.
Okay, what I said is that the request from external was 35,000 units. Do you understand? The request from external is 35,000 units. But the rule is that we must give 20,000 to internal. But if you sell this 35, it will be at 200 naira to external. And you know that selling this at 200 naira, the revenue will be higher than selling 20,000 to who? To internal at 105. So anytime there is a loss on the revenue like that, as a result of obeying the policy, company's policy, that amount that unit you're supposed to, you have opportunity to sell to external will be sold at opportunity cost. So looking at it now, we have opportunity to sell this whole thing to external. So it means the whole 200 or 20,000 units will be sold at opportunity cost. And to get the opportunity cost simply means market price minus variable plus variable. Is that clear now? And that's how we arrive at that. It's just revision.
Is the year November
2018. Question 2. So let's talk about the cost aspect now. For the cost aspect, we have variable costs. Do we have variable costs? What's the variable cost in the question? Variable cost in
The
the
variable
question.
cost is 105.
Okay, fine. That's correct. Variable cost is 105. But that 105 is per unit. What is their total capacity? 35. The variable cost will react to how many units you produce. So if you produce 10, your variable cost will also react to 10 units you produce. So which means the total variable cost will be 105 times 35,000. What do we get now?
3,675.
375.
675.
37.
367.
Okay, 3,675,000. Well, because we have not been writing thousand, let's clear this out. Then, because they ask us to find profit, assuming they ask us to find contribution, we just remove variable cost from these figures. But what they ask us to do is contribution. So we say fixed costs. What's our fixed cost in the question?
1,375.
1,375. So our total cost is what? 5 something.
Yes.
No, is it up to 5?
5050.
5050. That's our total cost. So to get our profit now, I can now say the profit. But like I can even do it here, but let me just. Okay. So profit will now be let me put total cost here. Total cost will be 5050 5050 then 5050. So profit will now be, maybe I should repeat this one here too. Okay, so for our profits, 5 this minus this, what do we get? I think 50, Abby. Should be 50 now. 50 profits. This minus this, that would be 430. 430. This would be 1950. 1950. And that's what they ask you to do. That is the profit they ask you to do. For division what? For division X. So if you now go to division Y now, if you look at division Y, you should be able to do division Y yourself. You should be able to do division Y yourself. I mean division Y yourself. But if you want me to do it for you, let's quickly look at it before we go to last diet question on transfer pricing. I will just do that one. It's under 50 minutes. We are done with that. Then I will now go back to that variance. I don't want to use more than, I think this class started by 2. So I've not used up to 2 hours. So I don't want to use more than 3 hours. So that you can go and read. We have covered everything. Just go and read. Okay, so to get for Y division, it will also be in 3 scenarios. Why will it be in 3 scenarios? The 3 scenarios will only affect X. But because of transfer between X and Y, it will also reflect in Y. So this is Y division. We have scenario 1, scenario 2, and scenario 3. So we'll start with their own revenue as well. But this division Y is not selling to internal. Their own sales is for external also. So we say external sales. How much? What is their capacity for Y? What's the capacity of Y?
Capacity of 10,000.
10,000. So it means they sell the whole 10,000 at what price? What's the market price? 800. 800. So 10,000 times 800, 80 million. Are you go?
So that's 80 million.
Is it 80 million?
80 million.
80.
80 million.
Let's do this one.
2,000, 80 million.
Okay.
8 million, that's 8,000.
Yes. 8,000. 8,000. 8,000. So this is their revenue from external. Are we good to go? Is there any other revenue they have? There is no other revenue because they only sell to external. So their own aspect is very simple. So that is their revenue. So we need to get their costs. They have their variable cost. Let's look. Their capacity is 10 units or 10,000 units. What is their variable cost? What is variable cost of Y?
Question that.
250.
250.
No, that is not that. 2 are transfer price. Two components from X is 2 are transfer price. You just write 2 are transfer price. Another variable cost 2.
I think we have to do it.
We have to variable cost.
Okay, the thing is that this 10,000 they are getting from, they are going to get 20,000 from where?
Yeah.
From Y.
Times 2
So
naira.
every 2
2 naira.
It becomes 20, Abi.
Yes.
Then what again? They will not spend how much?
another was 50.
So it means they are going to be having this multiplied by 2, Abi. Then times what? What is the cost? 250, Abi. What is variable cost? The normal variable cost now. They didn't give us any variable cost. They don't have any variable cost.
Just two components for
Yes, the other variable cost is 250, Abi. So times 250. What it means that they will first transfer, once they get it from Y, from heads, they will process it at 2 naira. Then they will now process everything again at the final stage. So what do we get for scenario 1 now? It's like this thing is too long here. To affect this one, Abi. $10, $2, $50. Oh yeah, 10,000, 5,000, 5,000, and 5,000. Any other thing? There's what we call there's what we call transfer price. I will call it transfer from X. Now, whatever division Y, whatever division X has recorded as intercompany, that is that 20,000 unit they are selling to Y, X will record it as revenue from their own end. Y will record this as costs here. So from X now, go back to the X. What is transfer price under scenario 1? 2-1, Abi. It will form part of the cost here. What is transfer price under scenario 2? 2,480. Then what is transfer price under scenario 3? 4,000. So it will form 4,000. Okay. Then, if you like, you can first do this one, get your variable cost. Then after variable, you now get your contribution. You still have another, yes, fixed cost. Okay, so let's get, because we are looking for profit. So what is fixed cost?
Fixed cost is 900.
900, 900, 900. So it means our total cost is what? Our total cost
is 8,000.
8,000. The second one,
8,380.
838, 8,380. The next one, 99.
So I think
No,
this
I think 5,000.
this variable cost is 2,000. They only say that 2 components from mix. I think it's already in the transfer from mix. That two that will multiply with 2. Is already in the transfer from X. But they don't say
Is that what the question says?
Yeah,
Let's add this one first. Okay, before we add. So what does the question say?
it says 2 components from X. That is that 2 components. You know that X it's 10,000 units, right? So that 2 naira is 10,000. So I think it's already
Become this one.
yeah, it's already in the transfer from X. I mean the 2 naira. It's only the 250 that.
So it's only 250.
Yeah, now multiply by 10,000.
So when you multiply that, what do you get? 2525 for all of them. 25. 25. 25. So what do you get? So we can get our profit.
How do you get to 5?
So this will change, Abby.
Yes.
So we should be able to finish this one. This is 4, 6, 5, 4. Is it 5, 5?
Yes,
Yes,
5, 500. This one,
5,000.
588.
8,800.
Then
7,400.
7,400. When you less it, what do you get? This will give us 2, 5. Am I right?
Yes.
This 1,
2,120.
2, 120. This one 600. And that's what they ask you to do. So let's take last diet question on transfer pricing. So after that, I will quickly run on I'm only borrowing 3 hours from your time, from your reading time. So I don't want to go beyond that 3 hours.
Because what about visa?
What else is to do?
If you calculate the financial account of the Y division, ignore the transfer pricing policy and purchase the 2,000 component that it needs from the external supplier for 170 each.
So that is simple. Now it means there's no transfer price again. So anything you want to buy, go and buy from the market. And they gave you the price for buying from the market at
It's 170.
170. So it means you are going to buy 10,000 units from the market at 170. Then calculate it again. There's no transfer price. Whatever you get, that's the answer. So we can look at that separately.
Sorry, sir, can you explain why we removed the 2 in the variable cost?
Now, 20 units from division X will make 10,000 units. 20,000 units from division X will make 10,000 units in division Y. So that has already been explained. They have already affected that in the capacity. Do you understand that? Because they are buying everything from division X. So there's nowhere else they are getting that capacity from. So it has been multiplied and they've gotten that figure already. So let's go to that
Okay,
question.
sir.
Yeah. So let's go to the next one. Let me quickly explain that. Why 2024? I just want to make justice to everything so that we'll be sure that everything is coming. You are ready for it. I think I dropped it here. To open it to PM, yes, to performance management, I think question 6 or 5 or so. Performance management last diet question. Question what? Yes, question 6. Question 6. This is another way of setting transfer pricing, whereby they will ask you to determine the price itself. So I'll read. Oforogere Nigeria Limited is a company located in Onitsha, which manufactures motorcycles. The company has 2 divisions, the engine division and the assembly division. The engine division manufactures and sells a standard engine and as used by motorcycle. The engine division supplies the manufactured engine to both the assembly division and external customers. The following information is available for the period in respect of the engine division. Capacity in units, 100. Which means they cannot sell more than 100. That is their capacity. Do you understand? The selling price to external customer in the intermediate market is 60,000. The variable cost per unit is 32,000. The fixed cost per unit based on capacity is what? Is 18,000. That is, if they produce the whole 100,000, 18,000, 800 units, 18,000 is the what? Is the fixed cost. The assembly division of the company can use the engine in the manufacture of motorcycles. The assembly division currently purchases 10 motorcycles engines at a cost of 58,000 per engine. So it means they can actually go outside and buy the material they need, which is the assembly division. Now, requirement 1. Okay? If the engine division is selling all that it can manufacture to outside customer in the intermediate markets, and 6,000 variable cost per engine can be avoided on transfer within the company due to reduced selling cost, what is the acceptable range, if any, for the transfer price between the two divisions? Now, this is where you need to now understand it deeply, what we mean by opportunity cost. Now, look at it. The capacity of this company is what? Is 100 units. Do you understand? There are two divisions, but our focus division here is, there are two divisions there, assemble and what?
Engine division.
And engine division. So this is engine division. Engine division want to sell to who?
Assembly.
So assemble. And they now told us that assemble also can go to the market and go and buy for how much? 58,000 naira. So they can go to the market, they may decide not to buy from the internet. Now, they now ask you, if the engine division is selling all that it can manufacture to outside customers, that is, they have 100 capacity. Internal will not be getting what? Will not be getting anything. They want to sell everything to what? To outsiders, which is what? The whole onwards. And then they said, if you look at it now, the whole 100, they said the assembly division currently purchased 10 motorcycles engine at a cost of whatever per engine. Now, let me ask you a question. The question you need to ask yourself is opportunity cost exist here? Does it exist?
Market.
Look at it. They are selling everything they have to Western. But the rule is that they should sell to who? To internet. But they are not selling to internet. They are selling everything to. So it means external will buy at what? What is the market price for external? Market price for external. They give us
60,000.
58.
60,000.
Thank you very much. It means they have opportunity to sell this thing at 60,000 to external. But they won't be able to do this because internal are requesting for the same units. So therefore, there's opportunity cost. Therefore, there's opportunity cost because they won't be able to sell to external and sell that manager want to get query. They must sell to internal. It should not be at opportunity cost. Are we getting that now? So all you just need to do here is to know the formula. What is the formula of opportunity cost? So now that you know that there's opportunity cost here, you will say, okay, opportunity cost simply means the market price minus variable cost, right? Then plus variable cost. So what is the market price in this question? 60,000. Minus variable cost. What is variable cost in the question? Is it 32?
Yes.
32. 32,000. Then plus 32,000. But that's not the end. If you look at the question, they said there's avoidable cost. How much is avoidable cost?
6,000.
6,000 naira. They said if the engine division selling all to the whatever in the intermediate market, there's an avoidable cost of how much? Of 6,000 naira. Is there another thing we have there? There's no other information given to us except that one. They said can be avoided on transfer within the company due to reduced selling cost. You can avoid to say that. So we have the 6,000, I mean. So it means this figure will reduce because they can avoid it. It will reduce the cost. If the total variable cost is 30, they can actually reduce this. They can avoid it. They may decide not to what? Not to incur this cost. So when you add everything together now, what do we do?
Now, 60 minus 6,000, 54,000.
54,000. Total, I mean?
Yes.
54,000 is opportunity cost. 54,000 is opportunity cost here. So what they're asking is that what should be the range? If you are the owner, if you are the manager, which one do you think you are going to buy? So opportunity cost is 54,000. Then market cost
60,000.
is 60,000. No, market is 58. 58,000. Not market price. This one is talking about assembly. 58,000. So if you are the owner of the business of assembly, which one do you think they are going to follow? They will follow opportunity cost because they lower. And this question really tests in-depth knowledge of transfer pricing. We don't know transfer pricing very well. You can't do this way because require adequate thinking. Okay, so we are done with this one. Let's do the second part, the B part. So if you have any story, you can add to it. The company should buy at 50,000 because it's opportunity cost and it's lower cost. Okay, for the B part now. The B part sales or II, if the engine division has ample idle capacity to handle all assembly division needs, what is the acceptable range, if any, for the transfer prices between the two divisions? Ample idle capacity. Now, we said our capacity is what? Is 100. Initially, they cannot go beyond 100. But they said they have idle capacity. It means if there's a need, if a need arises, they can actually produce more. They are not limited to 100 alone. They have spare space. Do you understand now? If you look at the first one we did, the 35 is the capacity. Internal will get 20. External will get what? 15. So they cannot go beyond this. Even when the external is requesting for 19, we'll say, sorry, we cannot go beyond 35 because we did not have idle capacity. But in this case now, assuming these people have idle capacity, there won't be opportunity cost. All they just have to do is to increase their capacity, go and produce more. And they will be having what? They'll be having 39. They will produce 39. So their capacity will now increase to 39. So it will now be 20 plus 19, 39. There won't be anything like opportunity. So the same thing happens here. These people have capacity, but there is idle capacity to produce more. Plus, you can plus with it. So it means they won't have any issue. In this case now, let me ask you, does opportunity cost, does it exist?
No,
No.
because now,
Because they can settle problem of both internal and what? And external. So in this case, opportunity cost does not what? Does not exist. And when opportunity cost does not exist, they are going to sell at what?
No.
so no, external market.
No, they will sell to internal.
Okay.
Your focus is on internal. Your focus, so it means sell at variable cost. We now need to know what is our variable cost here. 32. So 32 is our variable cost. So they will sell to internal at variable cost. Since they can actually produce and meet the demand of internal and what? And external. So if they are selling at this, the range will not be, because they said we should put it in range will be 32,000 to 54, is it 54 or 58? 58,000. But you advise them to pick 32 as the variable cost. Are you getting that just? So we are done with number 2. It's not difficult, just that you don't know the principle. Number 3, which is the last one, if the engine division is selling all that it can produce to outside customers in the intermediate market, what is the acceptable range, if any, for the transfer price for the two divisions? The two divisions. Now, they said, the first one, they said they can sell all they can manufacture to external customers in the intermediate, but the only thing that makes it different here is because of the avoidable price, avoidable cost of 6 naira. In this third one now, there's nothing different between third one and first one. They said if the engine division is selling all that it has or that it can produce, both the extra capacity they want to produce, they are selling everything to what? To external. And the rule is that they must sell to internal. What will be the opportunity? This is number 2, and this is number 3. Which means the capacity remain what? Remain 100. They can as well add more if they decide, add more capacity as they wish. But the rule is that they are not selling anything to internal. I mean, they are selling, there's a market for it. And everything is supposed to go to where? To outsiders. Which is going to be at market price. The question you ask yourself again, does opportunity cost exist here? Does it exist? It exists because they have opportunity to sell everything to external. So opportunity cost what? Exists. So sell at opportunity cost. So to sell at opportunity cost now, our formula remains the selling price. I mean, the market price, minus variable cost, which is 32, then plus 32. Because at this time now, there's no longer what? There's no longer avoidable cost. So our answer will be 60,
Yes.
So our answer will be 60,000 as opportunity. So if our opportunity cost is 60,000, then we will say the range is what? Is 60,000 to 58,000. At this junction, how are you going to advise the management? So go and buy from the external one. Go and buy from external one. And it's not more than that. It's as simple as that. I noticed that where they want to test, they push it forward. So first diet, second diet, you will see. They will bring the full story for you. So That's what they asked me to do. How many minutes do I have more? I've used 2 hours. So I have just 1 hour today to do justice to that. So take note of what we have done just now. The variance, the selling transfer pricing, the budget. We are going to likely test budget, and every other topic we have done. Every other topic we have done. But note that 3 aspects of it, especially the one planning and operation I just done. Okay.
Sorry, please, Mr. James, I have a question. This
Oh.
question, this number 3 question that we just told, they said
Yes.
if the engine division is selling all that it can produce to outside customers in the intermediary markets, what is the acceptable range? Yes, we have seen the acceptable range, but what is the acceptable range, if any, for the transfer price between the 2 divisions? They're talking about transfer price again. So it's not clear. We can only see the acceptable range, which is 58 to 60,000. Then what is the transfer price between the 2 divisions? Does it mean there's nothing like transfer price between the 2 divisions?
And that's what we said now. Yes, what I'm going to say, looking at that, because they want you to explain every answer you have got. Because they're talking about assembly, Abby, they're talking about assembly. So there will not be transfer price. So assembly should just go to the market and go and buy. Because if they are using transfer price, they will be buying, it will be costing them 60,000. Why they can get it outside at what? At 58,000. Is that clear now? So they should pick the lower of the cost. That's what they should do. Is that clear?
All right, thank you. Yes.
Okay, so let me stop this one as well.